Roughly 1 out of every 5 barrels of oil consumed globally moves through a narrow stretch of water in the Middle East. Most Americans never think about it, but that corridor quietly influences gas prices, shipping costs, and the broader economy. Tensions involving Iran are now putting that route under pressure, and when something this central to the global system becomes unstable, the effects don't stay contained. They move through markets, through businesses, and eventually into everyday life. In this video, we'll look at what's happening and why the tension in this region matters, how oil prices and markets are reacting, and how energy price changes spread through the economy. We'll also step back to see why the economic conditions are sensitive right now, how this shock affects different countries, how it's starting to reshape energy supply chains, and finally, what it could mean for Americans, from gas prices to jobs and the cost of living. The focus of the current tension is the Strait of Hormuz, one of the most critical energy choke points in the world. When concerns rise about disruption in this area, oil markets react immediately, even before any actual supply is affected. Analysts have pointed out that markets tend to move ahead of events in situations like this. Some have also warned that investors may still be underestimating how quickly things could escalate if shipping routes are directly threatened. That early reaction is what feeds directly into price movements. Oil prices have already pushed toward the $100 range as tensions have increased, even without a confirmed disruption in supply. Markets are pricing in the possibility of reduced flow, not waiting for it to happen. JP Morgan's commodities team has argued that the market may need even higher prices to balance supply and demand under current conditions. Their view is that pricing hasn't fully adjusted yet. That creates a situation where volatility becomes part of the baseline rather than a short-lived spike. Once oil prices rise, the effects move quickly across the economy. Transportation becomes more expensive, which increases shipping costs. That feeds into the price of goods, food, and travel. The IMF has outlined this dynamic clearly, noting that higher energy prices tend to push inflation higher while slowing overall growth. Some market strategists are now projecting inflation could move back toward the 4 to 5% range if energy prices remain elevated. As these costs build, they begin to affect multiple layers of the economy at once. The broader economic backdrop makes this more impactful. Growth has already been slowing, and interest rates remain elevated. Debt levels across households, corporations, and governments are still high. The IMF recently lowered its global growth outlook and highlighted the risk of further slowdown depending on how the conflict evolves. In scenarios where energy prices stay high, global growth could drift toward levels typically associated with recession conditions. When the system is already tight, shocks like this tend to have a larger impact. Higher oil prices tend to benefit producers and energy companies, at least in the short term. Countries that export energy see stronger revenues. At the same time, economies that rely heavily on imported energy face rising costs and slower growth. The IMF has described the current situation as a global but uneven shock, where some regions absorb more pressure than others. That uneven impact shapes how the global economy adjusts over time. Beyond the immediate price impact, this kind of disruption tends to change how countries and companies approach energy and risk. When a large share of global supply can be influenced by a single region, it forces a reassessment of dependence. Governments begin looking for more stable supply chains. Companies reconsider sourcing strategies, and investment starts shifting toward alternatives like renewables, nuclear, and domestic production. Executive Director of the International Energy Agency recently noted that the current disruption has already changed how energy markets think about geopolitical risk, saying that the damage is done in terms of how these risks are now priced. These adjustments don't happen overnight. But moments like this tend to accelerate decisions that were already underway. So how does all of this show up in the United States? Energy prices are the most immediate channel. If oil remains elevated, gasoline prices tend to follow, increasing weekly costs, especially for commuters. At the same time, higher transportation and production costs push prices up across goods and services. That makes it harder for inflation to decline, which keeps borrowing costs higher for longer. There's also a second-order effect on the job market. As growth slows globally, companies become more cautious. Hiring slows, and in some cases, cost-cutting begins. Put together, it creates a tighter environment, higher costs, less flexibility, and more uncertainty around income and opportunities, particularly for younger Americans already dealing with housing costs and debt. What happens next depends largely on how tensions evolve. If the situation stabilizes, markets may settle and some of the pressure could ease. If uncertainty continues, volatility in energy prices is likely to remain. What's clear is that events tied to key parts of the global system don't stay isolated. They move through pricing, through markets, and into everyday life. And that's why something happening thousands of miles away can end up shaping what people experience at home.